Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, August 9th, 2023. It is 2:44 p.m. as I'm starting this video. Although, as I mentioned earlier, I may not be able to get this video uploaded and out to you until after the close today. Pardon my frustration, that previous post, I'm captive to Comcast for internet service. Pretty much very few options where I'm at, and they happen to be the best, but it's in my opinion, a god-awful company, and I think most of what I read online says the same thing. We get constant outages here, and maybe it's because I'm in the lightning capital of the United States, and we have constant, thunderstorms and all that. Either way, so pardon my frustration. We've been out all day. In the last update, they said it might not be until 6 p.m. where they restore the service, and due to where I'm at, my cell phone tethering is the backup anytime my internet goes out, and unfortunately, where my office is located in the house, the signal is very weak especially for tethering and data. So I'm running all these charts and streaming platforms, and it kind of log jams and makes it almost impossible to upload a video. Even images are difficult. So, okay, I just wanted to clarify that's why this video may not get out to you until after the close. But here's the takeaways. We're going to go over really primarily two things here. We're going to look at the stock market via the charts of the indexes, and then I want to talk on the inflation trade or reflation, whatever you want to call it. So I'll go over that, especially because we have the CPI tomorrow. So let me just start out with the equity markets. This is a 5-minute chart. Lately, I've been posting this quite a bit and mentioning that, at times I'll go into active trading mode. And what does that mean? Even if I'll even hybrid it, if you will, longer term accounts, I'll swing if I'm looking for a up move or a down move, from point A to point B. I'll show you price targets on usually the 60-minute charts or the daily charts, sometimes even the weekly charts. And that's where I expect something to go. And I often say that, trade whatever, trade within your skill sets and your time frame. Not everybody can trade in and out active day trading on short-term charts, but I tend to do that if I think something's going from point A to point B. Within point A and point B, I have all these little, let's say that's lowercase a and lowercase b. I'll have, uppercase A and B, and then I'll have little lowercase or little numbers, if you will. In other words, that's the down move, and then I like to trade, as I pointed out, a lot of these divergent lows. And these are small, very small balances. To some, not even worth trying to game, 1% or so. But to me, trading a decent, when I go into active trading mode, using futures or leverage, you can use a decent size amount where it makes it very worthwhile. Like today, I got this one out to you. We hit support here. I'm going to go over those the support levels, all the things that hit support. Again, I couldn't get a lot of charts out to you because the problems uploading even the one chart I got out to you. But we had several key stocks, and the indexes hit support. And so, to cover a short, I gamed a bounce yesterday. I gamed these, all these little divergent lows, and they're part of the, downtrend. And these are all about 1%. So, for example, today, we hit support today at the lows, and I'll show you all those support levels in a minute. And it's good for about a 1% bounce. So, two things, in active trading mode. Number one, you're avoiding giving back 1% in profits on a swing trade that, relatively speaking, isn't huge. Since markets dropped, the NASDAQ 100 has only dropped from high to low so far in the last few weeks about 5.5%. So when you can turn around and squeeze out, sidestep a 1% give back and even turn that into a 1% profit, then you can easily, on a 5% drop, extract 10, 15% or more by active trading. Again, if the charts are conducive, and they have been lately, they've been, this is your kind of go-to time frame here. You can see all the divergent highs, divergent lows. I've been covering a lot lately. And so that's the one we had today. Now, the bigger picture is this. So we're getting to the point where we have those bullish falling wedges. I've been pointing them out here. It gets bigger. The divergence keeps getting bigger, but it's still very much intact. And this is a 5-minute chart. It shows all the way through. You have it here on the 15-minute chart. There's your same downtrend line, bullish falling wedge. I'll get to SPY in a second. This is just QQQ. This is it on that 60-minute chart again. So the setup is there. Let me be very, very clear. The setup, this is a bullish setup, 110%. This is a bullish falling wedge, complete with positive divergences. Now, on the flip side, we're coming off a much larger divergent high and on fresh on the heels of a primary trend line break. So this has a decent chance that it's going to be canceled out, but decent isn't great. And so again, I keep trying to just point out that's all I can do for you is tell you which way I think things are going to go. I've been persistent the last few days, to staying short for the swing trading, favoring the, we go down before a back test. And let me just tell you, and I'll get to this in a second with the show you where the report can be found. But we have two potential catalysts that are either going to break out, allow this pattern to break out and run, and break out and run. You could still, and that's a target. It's been my alternative scenario all along since we broke down here and started putting in the divergence, a back test of our test of this downtrend line I'm highlighting here with the arrow tool. And if it carries further than that, we could certainly, not much further, you have a back test of the primary uptrend line. And again, I think if that happens, we'll most likely get rejected there. So on either one, you have a confluence, you have price resistance around 380, 381. So a whole confluence of resistance right there. So again, a stop, if you shorted this breakdown here or anywhere recently, above there seems very reasonable and objective. However, and I'll say this often, divergences, although more often than not, they play out for a trend reversal, meaning positive divergences, which are bullish like this, during a downtrend will often be followed by a trend reversal and a rally. Likewise, negative divergences in an uptrend. But at times they do get taken out. I was pointing out divergences back here, a few months back that thought would play out, and they never did. This is a case, there's one I just drew where divergence was burned through on the 60-minute time frame and didn't play out. And what happens is when you have those clearly bearish setups, again, that's a trade setup. You had to break, which we never did. We needed to take out the bottom of the support zone. This was a breakout above the support zone. But when you have those potential bearish setups and they either fail to materialize with a sell signal to move down, or you break down, get a sell signal, and that's followed by a quick reversal, and the signal's a false signal, those are very bullish. And that was, in my opinion, a big part of the catalyst. There was a shift in the expectations for the market and the technicals earlier a few months back. And it gave us, that was the fuel, lots of short covering. I just read about it today in the journal. The amount of short covering is mind-boggling. It was the biggest amount dollar-wise since, what was it, oh gosh, I scanned the headlines. It was maybe 15 years or so. It's been quite a while. And to me, that's actually, they were spinning it as bullish, and fuel for more leg up, but that short covering's already happened. They're talking about the hedge funds that were long short hedge funds or short only. A lot of those have been blown out, and what that does is it clears out the short interest that's already been priced in. Big part of this was that short covering, and now that the short covering isn't it's at much lower levels, that gives the potential if the macro begins to shift. The macro meaning the fundamental outlook for the economy, it's a combination of inflation, what the Fed's going to do with interest rates, employment, corporate earnings, all that good stuff. It sets the way for a swift drop. That's what I want to point out. Now, likewise, this is a potentially powerful pattern. So I'm going to give you, again, there's the levels to watch. There's your downtrend line. It's clear as a bell. I've been highlighting this for the last few days. And so, and you also have price resistance there. I'm on this 60-minute chart about we'll call it 372. We'll round up a little bit. And, there it is. So That's something to watch for tomorrow. We're so late in the day, and with the CPI and employment data on deck for tomorrow morning, I would, my suggestion, I can't tell anybody what to do, but personally, I would take a breakout that occurs today, late session, with a grain of salt. What I think we're going to see is probably a late session dump today, for the reasons I'm about to get to. So I just wanted to show you the setup is there, which way I go, and whether I decide to, try to ride that up long or push it down short. I can tell you this, with the CPI and employment numbers tomorrow, I don't think it makes sense to go home very aggressively long or short. That's my opinion. You can always, those numbers come out, I think, at 8:30 tomorrow morning. You can always re-engage, on the long side or the short side once that's out of the way. But it's like anything. It's like holding into earnings or a big FOMC meeting. It's a crapshoot because it can go either way. So that's it. There are the levels. Wanted to point that out. I'll point it out on. Let's take a look at. Let's look at SPY real quick. SPY has that same, almost identical bullish falling wedge right there. Nice and clean, lots of reactions. That helps to validate a level. I always say that the more reactions you have, the more eyes are going to see it. Some might try to pick up on a trend line with 2 or 3 reactions, and a lot of people aren't going to see that. And the more reactions you get on a downtrend or an uptrend, the more eyes see it, and then it becomes more relevant in technical analysis and trading. So now you have some pretty big resistance just above. I could certainly see, and I'll tell you, I'm leaning towards the possibility if we do pop it, if we do break out, that breakout will probably get sold into and fail. So that's what SPY looks like on the 60-minute chart. Again, I would be remiss not to point this out. So you guys trade it as you want. Daily chart. Let's not get in. Yeah, we still have, again, this is a kind of an overriding factor, if you will, or something I put a higher weighting on. I put a much higher weighting on what's happened on the daily chart than I do on those little 5-minute charts. So I just showed you a 5-minute bullish falling wedge. I threw this one out in the comments section earlier. Below that last post I got out to, there's a 5-minute wedge on SPY. Remember, QQQ hasn't broken out yet. It's a beautiful little wedge. And, normally all day long, this is, what you want to go long and what I'd normally be going aggressively long on. But remember, SPY just broke out barely. We're right there. There's price resistance. I think we'll probably get a pullback into the close today, most likely. And QQQ has yet to. And you can see with QQQ, in addition to just gaming these little divergent lows, especially when those divergent lows are at support. I don't just buy pullbacks, random pullbacks, or pullbacks just because you have a divergent low, because divergence can and often does become larger. It's a divergent low at support or where you want to buy. You buy support, whether you're dip buying as a bull for a move to new highs, or you're a short seller, or you're short in a position and you're just micro managing that trade. You want to cover that short, game the bounce, usually into resistance, get back short again, game the, cover that short, game the bounce. That's what I was talking about. So you can see we're still a little bit above the downtrend line on QQQ, and it is a setup, and that's all it is. It's an untriggered setup. So SPY has moved above its trend line by a hair. It's right on it right now. In QQQ, it's a little bit above with big resistance right here. I believe I mentioned this resistance the other day. It's about 371.50 to about 372 right there. You have all these reaction lows recently, and then you broke it and you tried to back test it, got rejected. So this is big for QQQ. If it can pop it and hold that breakout, that's bullish, and you're probably going to run up quite a bit. Measured target for the wedge. Any wedge is the widest part of the wedge. Or if we do that there, add it on to where it breaks out. That's again a measured target for it. You can also measure it on the 60-minute chart. And just a quick update on the futures. This is what it looks like. So bigger picture, this is my 120-minute chart with 2-hour candlesticks. Goes back 6 months. Beautiful, beautiful, beautiful uptrend line. I keep referring it to it as a beautiful uptrend line. Beautiful because you have a lot of reactions to help validate it. So a lot of eyes should see that, especially NQ traders. And there's your breakdown. So we're just fresh off the breakdown, hasn't met its measured target. And so again, We all see what we want to see. And again, my job is to point these things out to you and you decide how to trade them. I'll always give you my 2 cents, whether I have a strong conviction or not. I'll try to share how strong my convictions are. And so, I can certainly see the possibility. I would not be shocked or surprised to see that, although still not what I favor. I'm talking about the breakout to go and back test and get a rejection. I'm leaning towards this whole thing falling apart. In other words, whether we have a breakout that fails quickly after or it never breaks out, that's what I'm leaning towards. And my targets have not changed. Remember, these are little micro levels here, but these are the thicker lines I have. This is a first swing target. If you're not actively trading, if you don't have the skill sets or the time to game little squiggles on the 5-minute charts, then this is where I think we're going to go before the first decent reaction, about 14,855, followed by 14,427, and quite likely 13,503. That hasn't changed. That's my 120-minute chart. So I've shared screenshots of it recently, and it's in most of the videos. Then you have the other time frames I'll trade. This is a 15-minute chart. And you can see these divergences show through all the way from the 5 to the 15-minute chart. And same downtrend lines right there. You can go down to a 5, but let's just leave it at this. Oh, let me show you one more thing. On trading the short-term charts, you look for little clues, especially what's going on recently. And I've noticed here on the 5-minute, it's about that tag. The red line is the 70 level on the RSI, which is typically considered overbought on most charting platforms. And generally speaking, oversold is 30, overbought is 70 or higher. And you can see when you get up to about that level, I'm just circling them, that seems to be where these counter trend rallies stop, right? So just wanted to point that out. I noticed that before the video, and that's one reason I closed out that. And that's right about where I showed you earlier, where I had it going a little bounce trade, bounce up to there. And I think I think either way for me, that's all I wanted to milk out of it. And so now I think we'll fade into the close. Let's talk about why I think we'll fade into the close. Let's do this. Okay, economic calendar. This is available on the right side of the chart under resources. You go into the under tools of the trade once you click on resources, and there's a link to the economic calendar. So I'm going to zoom in so you can see it in the video here. Right over here we have the tomorrow CPI and jobless claims. So those are 2 potential market movers. That's why you have the red stars there. The consensus for the CPI. This is right now, this is about everything. Tends to be the biggest report everyone's hanging on. I think soon we'll start to see employment come into focus. So just keep an eye on that. Right now, we've continued to have pretty benign or bullish employment numbers. But just remember, and you can do this, I didn't have this chart queued up. Go back all points in time. Go back 30, 40, 50 years, as far as you can go. There's quite a few sites. Just Google, S&P 500 or employment data chart, and you'll see that all expansions end or all recessions begin are followed by historically low unemployment. And again, you'll see that. So right where we are. So where that's being cheered and lauded as a net positive, and it is as long as you stay there. But when you look at the cycles we've been at, and you rarely stay down at that super low level for long. And again, if you go back to those charts with the shaded area showing recessions, I didn't have one queued up here, you'll see. So what you want to watch for, where I'm going, is that tick up following a period of unusually lower, low end of the range on unemployment. And so that'll be one to watch tomorrow. And that could, each and every one of those have the potential to roil the market if it comes in quite a bit above expectations. Again, the jobless claims tomorrow. But let's look at this one. This is CPI, Consumer Price Index. Month over month, the consensus right here is for an increase of 0.2%. All right, last month we had a 0.2% increase. Remember, this is for the month of July, even though we're in August. It's August 9th. Tomorrow they're reporting on the 10th. It takes that long for the data to be finalized. And so we're going to talk about CPI in a second. Year over year, they're looking at a 3.3% increase. Even excluding the volatile food and energy, they're looking at a 0.2. So you see core and X food and energy are the same number tomorrow, 0.2. My bet is that it's going to come in hotter than expected, and that's market. And depending how hot, here's a consensus range: zero point 0.1 to zero point 0.4. Some, a zero point 0.3 might not rock the markets, but anything at or above the top end of the range probably will. And of course, that's simply because it means the Fed will have to be, forced to continue to be hawkish, and that should instantly increase the odds of another hike. Um, and let me show you this chart. Okay, this is from pewresearch.org. And it says what goes into the consumer price index right here. Shelter, by far the largest. That is housing. They don't use home prices. They use owner equivalent rents, of course, rents as well. But it's a big component. And there's nothing close to a real-time indicator. Almost all this data is lagged. Rents and the home sales and all that good stuff. So that's a big question mark, and I do have to acknowledge that plays by far the biggest component. And it's going to be hard for me to say where that's coming in. I just don't have a real-time indicator. Food, 14% CPI roughly is food. And one thing that I've showed you for years, I've been following, especially over the last couple of years, where everyone's hyper focused on inflation, is the commodity prices. However, this is most of what this number is has to do with food prices in the store. Where is it? Right here. Where we go? So the supermarket. So second biggest category, food. It accounts for just under 14% of the index. Groceries or food at home makes up a bit more than half of that category. So again, I'd have to go to grocery store, and they go to different locations throughout the month. That's how the CPI is taken. It's not a spot check. They do gather those prices throughout the month. And again, we've seen an uptick in some. I don't have much of an opinion there either. So I'm just going to kind of put a question mark as to what kind of contributions shelter and food's going to have. But this one I have a strong opinion on, and it is the third largest. So this one does count. This one does matter. Energy, 7.5%. All right, let's dig into the charts. By far, the biggest impact is crude oil. Whether there's various sources of the energy component there, heating oil and gasoline and all that. But what I've done for you here is measured, and I've talked about this quite a bit. This is the month of July. From this was the closing candle on the end of June right there, and this was the closing candle right here. It was a nearly straight up vertical ascent. All these other periods back here we had big moves up, that wasn't beginning to end a month. It was usually you started the month here and you ended the month there, and it's been mostly benign inflation month over month. And you can also look at year over year. Now we're back to, crude prices are back to where they were, when things were really putting pressure on the stock market. Either way, we've also broken out technically. I've talked about that recently. Crude oil, told you this was a big level to me right here, and crude's clearly broken out and moving away from there. So not only do I expect crude to cause a hot print, at least where it contributes to the CPI for the month of July. But, going forward, unless this breakout fails and fails pretty hard, we're probably going to see that again. And this is what I promised you. And I saw this headline today. I've been talking about this for a few weeks with interest rates, treasury bond yields, and the inflation trade. That, everyone was cheering, high-fiving. Fed won. They did their job. Inflation's over. Now we're in all this talk recently about deflation. I said, watch, they'll take a little bit of an uptick here and there in these commodities, but when you see something like this, at this point, the markets will begin to become hypersensitive and hyper-focused on it. So where it might not have been an issue here halfway through July, I think it will be here, and especially the fact that we continue to build on July's gains so far in crude oil. Crude oil is not the only energy component. You can go to UGA if you want to track real time, get a good idea on where gas prices are. UGA is the unleaded gasoline ETF. This is my chart of it here. Just like crude oil, you had this big level here, about 65.52 right there. It's been capping, controlling or capping this trading range that we've been in really since that blow off top, that peak in crude. But look where crude is, just like treasury bonds. You're running back to those multi-year highs. This was the peak in gasoline prices right here. We're not that far from it now. And we've clearly, so a couple takeaways, we've clearly broken out. That's bullish. We hit this reaction high, pulled back a little, but we're well above there. And then when you look at what it did in July, up 17.25%, measured it out here, again, by looking at UGA. So that's that. And that is why I think we will see a fade today. I'd like to think that the smart money sees some of these things that I see. And if I was we know that the hedge funds, a lot of the shorts have been blown out. So we know there's much more long exposure in the market right now than short exposure. So if I was a hedge fund or mutual fund manager or pension fund manager and I had these big fat profits, I would be nervous about the CPI tomorrow, as well as the job numbers. And so therefore, that's why I think we'll see at the end of the day here a lot of longs. There it is. There's the turn I was looking for. And we'll probably continue to see that go down today, despite this bullish falling wedge, which normally I'd be, getting pretty aggressively long. So that was it. Milked my little long, back short for the close. For that, I think you'll see, profit taking because they can't do anything. Those numbers come out before the market opens. So they've got now, as I speak, it's 3:11 p.m. You have less than 50 minutes to get out of your longs or face being caught on the wrong side of the gap. Now, look, that can go either way. CPI, a lot of people say it's a bunch of BS, fudge numbers and all that. So we'll see. I just don't see how any way that they can distort the energy component of it. But again, energy is only the third largest, and so maybe that could be offset by big drops in housing or groceries or anything month over month. And so, all right, guys, that's what to look for. These are the levels. And look, if CPI comes in as expected or even cooler than expected, and the job numbers look good and are benign, the market likes what it sees, you could break out. And then the takeaway is respect that. You want to keep tight stops. There's your little 5-minute wedge, which would then lead to a breakout. Remember, that's a seemingly minor little 5-minute wedge, but here it is on the 60-minute chart, and there's some price resistance. So if you want to keep a relatively tight and objective stop in QQQ, would be right there, a little bit over the 372 level. I would zero in like this is what I would do. I see a couple reactions right here and a big old gap, 372.50, so somewhere in there. That if you can give it a 60-minute close, that might allow for to sidestep a little whipsaw false breakout. But that's still my preferred scenario based on everything I just discussed. And but however, that's something you don't want to. If that doesn't happen and we go up for a back test of that, you probably wouldn't want to ride that out short. You'd want to be in that long, or at least get stopped out of your shorts and then wait for an objective reentry. If you are, if you're the same mindset I am that this market's going to go, in the coming months a lot lower. All right, I showed you crude, but nat gas too. Let's not forget. I didn't update this right now in the video yet because I got a chart out to you today. But I got the 60-minute chart out to you. We hit that second target there where I expected a reaction. That's what you call reaction all day long. A reaction to me is when you're going up and you hit a resistance level. A reaction is one of two things or a combination thereof. It is a pause or a pullback. And so this right now, that's a solid reaction. It's the more bullish of the two. You did pull back. I mean, you hit that 807 target I had almost to the penny. What was the high of the day in natural gas? 808. So sorry, guys. I was a penny off on that one. And that was a target given way back here in June or July. After that divergent low. But so far, a nice reaction, and more so in time. Reactions like, one of two ways. I always say, throw a tennis ball or a hacky sack at a floor. The tennis ball is going down. The reaction is it hits and it bounces. And a hacky sack is going down. The reaction it hits because it's full of sand or whatever. It just stays there. And this is that hacky sack type reaction so far. And we could still go down. And it's simple stuff. Whether we pull back or not after today, a breakout above that 807-ish level should open the door to the next move up. And again, natural gas put in this divergent low, and bigger picture, and I've been talking about for a while, is this potential basing pattern right here. Just, and we're starting to clear that now. And the farther you get away from it, the more eyes are going to see that, and then nat gas has the potential to run. And so if you're not an active trader, just raise your stops and let it run, because I will almost certainly add additional targets. I keep talking about it, but I'll add additional targets as if and as this thing begins to get some traction. And then the other takeaway to that is, remember, this is as part of the big energy component of the CPI is also electricity and heating. Most utilities, most power plants, the primary fuel sources are natural gas and coal, and both those prices have been moving up. So you're going to see, you've had this big abatement, and the market cheered it, and the market rallied. Lower energy prices, especially with natural gas. But as I just showed you, crude is closer to pushing its all-time highs, same with unleaded gasoline. And I mentioned to you just the other day, I favored natural gas. I think had more upside than crude, and that's certainly been the case just in the last, look at this, 1 week advance. Let's just measure it out here, and then I'll wrap the video up. Nat gas has rallied via UNG 21% in just the last week or so here. Five green candles right there. So all right, guys, let me wrap it up. And like I said, as soon as I can upload this, I'll get it out to you. Internet's still down, so it may be after the close today. And if anything big happens in the morning with the jobless claims and CPI, I'll get something out to you. Otherwise, we'll wait and see what happens after the market opens. But most importantly, you have the levels to watch: resistance levels, support levels, and remember to just react appropriately, and don't be married to any one thing that the market must do. I'm being very flexible right now. Either way, ready to engage that rally on the upside if we break out of those wedges and it looks like it's going to stick, or press it hard on the short side if looks like those wedges are going to fall apart. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.